A major property transaction closes in a global financial capital in the early 1960s. The name on the paperwork belongs to a company few would recognize at the time. But the cash flow doesn't stop in that city. It moves through layers of holding companies until it reaches Rome, until it reaches the Holy See. This is how the world's oldest institution built one of its most opaque asset portfolios. For decades, Vatican finances operated with limited public transparency and minimal external oversight or independent accountability. In recent years, the Holy See has published partial financial disclosures, though large portions of asset holdings remain difficult to trace. The Holy See is both a religious institution and a sovereign entity under international law. That combination provides legal privileges most organizations don't have, and makes its financial footprint unusually difficult to trace. But real estate leaves traces: property records, tax filings, corporate registrations in jurisdictions worldwide. And what those records reveal is this: Vatican-linked entities control billions in real estate globally, though the full scope remains unclear. Most people assume the Vatican's wealth is in art and artifacts: the Sistine Chapel, St. Peter's Basilica, priceless paintings and manuscripts. That's accurate, but those assets are illiquid. You can't liquidate the Sistine Chapel for operating capital. Real estate is different. Real estate generates cash flow. Real estate can be leveraged and restructured. Real estate can be sold without headlines if structured properly through the right intermediaries. And Vatican-linked entities have been accumulating it for decades across multiple continents. The Vatican doesn't typically buy property under its own name. Instead, it uses a network of intermediaries, a PSA, Administration of the Patrimony of the Apostolic See. Then there's IOR, Institute for the Works of Religion, better known as the Vatican Bank, and regional Catholic foundations, dioceses, and investment entities operating globally. Each layer adds distance. Each layer obscures direct ownership. Each layer reduces immediate public scrutiny. Public disclosures and investigative reporting indicate Vatican-linked holdings across major cities, including London, Paris, and Geneva. Properties registered through charitable trusts, holding companies, and offshore entities in jurisdictions with minimal disclosure requirements. The structure makes comprehensive tracking extremely difficult. What becomes visible often only emerges during scandals or legal proceedings. Manhattan has historically been a target for institutional real estate investors seeking stable, long-term returns. Vatican-linked entities reportedly held properties in New York for decades, though specific holdings are difficult to verify independently. What can be verified is the structure, intermediary purchases, charitable exemptions, layered ownership obscuring ultimate control. But reported Manhattan holdings are small compared to what emerged in London during a major scandal. In 2020, a London property deal forced rare public disclosures about Vatican investment activity overseas. The revelations were significant. Vatican-linked entities owned over $1 billion in London real estate, luxury apartments in Chelsea and Knightsbridge, commercial buildings in Mayfair generating rental income for decades, and a controlling stake in a luxury development at 60 Sloane Avenue in South Kensington. That last one became a public scandal that exposed Vatican investment operations to unprecedented scrutiny. According to court filings, the Vatican invested over $200 million into the project through intermediaries and offshore structures. The property sat unfinished for years. Costs ballooned. Millions went to fees paid to consultants and middlemen. By the time the Holy See intervened and exited the deal, the investment had suffered substantial losses. The full breakdown is on Luxona Vault. Here's the mechanism that makes this structure possible. The Vatican is a sovereign state under international law. Under international law, sovereign entities may be exempt from certain forms of taxation in foreign jurisdictions. That can include property tax, depending on local law and how ownership is structured. In some jurisdictions, properties held through religious or charitable entities may qualify for exemptions or reduced tax treatment. The result? Real estate holdings generating income with potentially reduced tax liability across the portfolio. Compare that to a private investor buying the same properties in the same cities worldwide. A billionaire buying a $50 million apartment in a major city pays substantial annual property tax. Vatican-linked entities holding similar properties may qualify for exemptions. That's not evasion. It's sovereign and religious status. The Vatican's real estate portfolio isn't illegal. It's just unusually difficult to see in its entirety. Because the Holy See isn't required to disclose holdings in most jurisdictions, the full portfolio remains largely unknown. Independent estimates of Vatican-linked real estate vary widely. Because full disclosure is not required, the true value remains uncertain. What we know comes from leaks, scandals, and occasional forced disclosures when investments fail or attract legal scrutiny. The 2020 London scandal revealed properties the Vatican had not previously disclosed outside senior church leadership. Investigative reporting has found Vatican ownership in properties across Rome, Paris, and Geneva held through corporate structures. Each revelation suggests the same pattern: a global portfolio built over generations, structured for opacity and minimal accountability. The mechanism isn't complex, it's just layered. Purchase property through intermediaries not immediately connected to the Vatican. Register ownership under charitable or religious entities. Minimize disclosure through sovereign immunity protections in multiple jurisdictions. The result is a real estate portfolio that operates largely outside traditional financial scrutiny and regulatory oversight. Most Catholics are unaware. Vatican-linked entities own luxury apartments in London, generating substantial annual rental income. Most New Yorkers are unaware. Church-affiliated organizations reportedly held commercial properties in Manhattan for decades. Information asymmetry creates operational freedom, and the Vatican has understood that principle for centuries. Most large institutional investors disclose their holdings publicly. Pension funds, sovereign wealth funds, university endowments publish annual reports. They file regulatory documents. They answer to stakeholders, beneficiaries, and sometimes the public. The Vatican answers primarily to itself. That's not criticism. It's mechanism. It's how the structure functions. A sovereign religious institution with limited disclosure requirements can accumulate assets in ways other entities cannot. And over decades, that structural advantage compounds into billions of dollars in holdings across multiple countries. The London scandal wasn't fundamentally about illegal activity. It was about mismanagement and poor investment decisions. According to court proceedings, the Vatican overpaid for properties. Trusted intermediaries who collected excessive fees, lost substantial sums on failed developments. But even in scandal, the underlying structure remained largely intact. The mechanism survived. The portfolio continued operating because sovereign immunity shields the Vatican from many forms of legal recourse in foreign jurisdictions where it holds assets. Investors who lost money in Vatican-linked deals often had limited options for recovery under international law. The properties remained under Vatican control, restructured through different entities, and the portfolio continued generating income. That's the structural advantage. Not that it's perfect, but that it's protected by sovereign status. The Vatican's real estate strategy follows a consistent observable pattern across markets where it has disclosed holdings. Target high-value properties in major financial centers: London, Paris, Geneva, Rome, where Vatican influence is strongest. Purchase through intermediaries to minimize immediate public attention. Structure ownership through charitable exemptions or sovereign-linked entities, generate income while potentially minimizing tax liability, and disclose nothing unless legally compelled by scandal or investigation. In Rome, Vatican-linked entities control substantial portions of the city's real estate, though exact percentages are disputed. Residential buildings, commercial properties, undeveloped land, hotels, office complexes across the historic center. The exact inventory is difficult to verify because Italian law doesn't uniformly require the Holy See to register holdings. Investigative reporting suggests Vatican-linked entities own properties in exclusive Parisian arrondissements favored by institutional investors globally. Luxury apartments, historic buildings, long-term leases, generating rental income flowing back through corporate structures. The Vatican Bank reportedly holds real estate investments across Geneva and Zurich in prime commercial districts, each property structured through Swiss holding companies, adding another layer of distance from any direct public record. The mechanism scales globally because the structure is consistent. Sovereign status, potential tax advantages, limited disclosure requirements, and a time horizon measured in centuries, not quarters. That changes everything about long-term investment strategy. Most institutional investors optimize for relatively short-term returns, 5-year holds, 10-year fund cycles, quarterly performance pressure. Vatican-linked entities can hold properties for generations without external pressure to sell or report quarterly earnings. That changes the investment calculation entirely. A property losing money for 5 years isn't necessarily a problem. A development sitting empty for a decade isn't automatically a crisis because there's no earnings call to explain it. Investigative reporting suggests Vatican-linked entities bought properties in the 1950s that didn't become profitable until decades later. 30-year holds, 40-year holds. Normal operating procedure when you have no shareholders demanding quarterly returns. Here's what most analysis misses about Vatican real estate operations. It's not just about total portfolio size. It's about the structural advantage of operating outside normal market constraints and competitive disclosure pressures. No quarterly reporting requirements, no shareholder lawsuits in most cases, no regulatory disclosure in many jurisdictions. Vatican-linked entities can wait out entire market cycles, can hold through prolonged downturns, can avoid forced selling. That's a structural advantage worth potentially billions in avoided losses and captured upside over multiple decades. When the 2008 financial crisis hit, many institutional investors were forced to liquidate holdings at depressed valuations. Vatican-linked entities reportedly maintained their positions, waited for recovery, potentially acquired distressed assets through intermediaries. By the early 2000s, many global property markets had substantially recovered. Some holdings appreciated significantly during the recovery. That's the power of extended time horizon combined with limited transparency requirements in most operating jurisdictions. But the mechanism has vulnerabilities, and those vulnerabilities became publicly visible in the London scandal. According to court filings, the Vatican trusted intermediaries who charged excessive fees relative to market standards for similar transactions, paid inflated prices for properties that independent valuations later showed were below claimed market value, lost substantial sums on a single development because internal oversight was insufficient to catch the problems. That's what can happen when you prioritize opacity over robust internal oversight and external accountability mechanisms. The Vatican eventually removed the cardinal overseeing the investment, restructured the entities involved, hired new external advisors. But the underlying structural challenge remains. How do you maintain accountability when disclosure itself is minimized by design? The answer appears to be you accept occasional losses as the cost of operating with maximum opacity. And for the Vatican, that trade-off may be acceptable, because the alternative is substantially increased public transparency. Transparency means comprehensive disclosure. Disclosure means external scrutiny. Scrutiny means questions about asset allocation and institutional priorities. So the mechanism continues operating largely as designed. Properties acquired through shell companies and offshore structures. Ownership obscured through multi-layered charitable trusts and sovereign-linked entities across multiple jurisdictions. Income flowing back through corporate structures that most outside observers cannot fully trace or independently verify. Publicly disclosed Vatican-linked real estate holdings span at least 15 countries across 4 continents. The actual scope is likely larger, because for every property disclosed through scandal, others likely remain undisclosed, held in corporate structures, trust arrangements, offshore entities, registered in jurisdictions with minimal public disclosure laws. The Vatican isn't unique in using these structures. Sovereign wealth funds use them. Ultra-high net worth individuals use them. But the Vatican combines sovereign immunity with religious exemption, with centuries of institutional experience managing opaque structures. That combination is difficult to replicate and difficult to penetrate from outside without internal cooperation. Information asymmetry is one of the oldest forms of institutional power. The Vatican didn't invent it. When you control information flows, you control external perception. When you control perception, you influence valuation and opportunity. The Vatican understands this principle at a level most modern institutions will never reach. This is Luxona.